In fact, let's discuss markets at large with Andrew Holland, the CEO at Avendus Capital Strategies. Thanks, Andrew, for joining us here on ET Now. Always a pleasure chatting with you. Good afternoon. You know, we've seen very volatile sessions, choppy ones, swings as well. What do you make of the markets at the moment? And is this kind of volatility here to stay simply because there doesn't seem to be an immediate trigger at the moment?
Yeah, I think volatility will be here for a little bit longer. I think the reasons behind that are manyfold, but let's start with the global factors. Obviously, President Trump is hovering around that destruct button again in terms of trade, and I think it's not going to take too long before we see what kind of sanctions he's going to take against either China, Europe, or everybody really, and then what the retaliation might be if there is to be any. And I think that's what's spooking at the markets at the moment in terms of how far is he going to go, and how much is the retaliation going to be. So that's the first part of volatility. The second part is obviously in our own in India is the banking sector, and particularly the PSU banks. Whilst we've seen some kind of relief rally in the past few days from the kind of devastating impact PNB has had on the sector, we're still not out of the woods, and I think we're kind of all grappling to think about is there anything more out there that we need to know, and that's really where I think the markets are just getting a bit nervous. So, if you had a global sell-off similar to what we saw in kind of February, then there's no real fundamental reason for our market to kind of go against that tide, and I think that's where we all are in terms of still a bit nervous for what happened in February, and then nothing really has changed to give us any reason to be pushing markets a lot higher at this point.
While we're talking about these global factors that you've just highlighted, Andrew, and I'm not going to talk about the banks right now. I'm sure that's a conversation we'll have soon. But just the companies and the sectors with a high exposure to U.S. exports, it could be pharmaceuticals, it could be IT, steel, gems and jewelry. Should one stay away from these sectors just given the fact that there's no clarity? You've got a WTO meeting coming up. Donald Trump has been complaining about what we tax Harley-Davidson's at. India's already, resorted with hiking custom duty on smartphones.
Yeah, I don't think it's really going to be so much on the pharma and IT. I think it's more on the manufactured goods in terms of gems and jewelries and other products. So I'm kind of a little less worried about that. I don't think the impact on India one way or the other is going to be so significant that that's of concern. I think it's more of a global trade war or protectionism, which could come about if he goes around putting sanctions on both European and Chinese and Japanese and any other country. So that's the real worry at the moment, and the new kind of economic advisor yesterday kind of reiterated that that's where they're going to be looking. So that to my mind is more worrisome than what we would see with India. So I'm kind of less worried about that, to be honest.
Hi Andrew, this is Siddharth joining in conversation. Now, the proponents of free trade, and I believe most of us are proponents of free trades, bring in efficiency in manufacturing goods and thereby reduces the cost of finished goods. If these kind of protectionist measures, pop up everywhere, there is a risk, and this is a question: is there a risk of the inflation rising? And do you think that would probably lead to a change in interest rates or pace of interest rates in US faster than expected?
Yeah, no, that's a great point, and obviously, tariffs are, really a tax, right? So it pushes up the price, you know, locally because the demand is local and prices will move higher because of the tariffs. So that will you know, kind of push inflation higher in the shorter term too. So what you're saying is that you know, will we have 3 interest rate rises, or will they be bigger than the market expects if they keep it to 3, or will they be 4? And I think that's again what the market's trying to grapple with at the moment. At the moment, it's kind of saying, well, okay, we had poor retail sales, you know, so you know the 10-year bond yields kind of you know, kind of jumped below, you know, 3% and gone kind of a little bit lower, but it won't take much for inflation to come back. And the jobs report, to my mind, was, you know, just showed that the, you know, the jobs growth is so strong, wage growth will have to come very soon. So I think the market's only looking at the very short term at the moment in terms of the news. But I think there's enough out there to make us worry that the interest rate cycle might be a little bit faster or a little bit quicker than anyone's anticipating right now.
Right, and if I have to be India specific, or I would say EM specific, then how are you seeing, you know, liquidity shaping up? We are now seeing that, you know, the liquidity parameters like dollar index is stabilizing, crude oil price movement is not very great. Also, US 10-year bond yield, which was threatening to go past 3% level, has been, you know, taking a breather. You think this stability can bring back the liquidity, or there are some other factors which need to change for FIs to change their mind and start investing in emerging markets like India?
So I think the one thing that hasn't changed so significantly despite the market falls has been that valuations still remain elevated in India. You know, we're one of the, you know, most expensive markets in emerging markets generally. So there's no real need to rush to buy India given the valuations, and I think given the problems in the banking sector at the moment, because, you know, the fallout from that is, I think, a little bit more wide reaching than maybe just the banking sector alone. And I think that's why you're seeing you know, FIIs kind of look to sell, not just in the equity markets but also the bond markets, because, you know, if this leads to, you know, the banks, you know, kind of sitting on their hands, and borrowing costs are going to get higher along with interest rates. So that's the kind of, again, the extra concern for India. So I don't think, I think from a valuation standpoint, we're not compelling enough yet for FIIs to be wanting to buy, even with the little bit more stability in global markets that we've seen in the past week or so.
Well, that's a, you know, a minority opinion, but Andrew, certainly valuations are not looking cheaper. Unlike most of the fund managers here, they feel that visibility is very high and valuations or the earnings would catch up to justify valuation, but certainly FIs would, you know, look more from current perspective. Thanks, Andrew, for joining us and throwing light on the global as well as some of the domestic situations which our markets are facing in form of headwinds. Thank you for joining us.